Curious about what really moves the crypto market? You're not alone. It's a mix of many factors that can feel confusing. In this video, we'll break down the key forces behind crypto's price changes so you can understand what's really going on. Before we dive in, be sure to like, subscribe, and hit the notification bell so you never miss easy-to-follow crypto insights. Let's get started. Market sentiment and social media influence. Market sentiment is perhaps the most powerful force in cryptocurrency markets. Unlike stocks backed by company fundamentals, crypto prices are heavily influenced by collective emotions and perceptions. Fear, uncertainty, and doubt, FUD, can trigger massive sell-offs, while fear of missing out, FOMO, drives buying frenzies that push prices to unsustainable levels. Social media platforms like Twitter, Reddit, and Telegram serve as real-time sentiment indicators and price catalysts. A single tweet from influential figures can move markets instantly. Elon Musk's tweets about Dogecoin or Bitcoin have historically caused significant price movements within minutes. Reddit communities like r/cryptocurrency and specialized Discord servers create echo chambers where sentiment spreads rapidly among traders. The psychological aspect cannot be understated. Crypto markets operate 24/7 with high volatility, creating an environment where emotions run high. Retail investors, who make up a significant portion of crypto trading volume, are more susceptible to emotional decision-making than institutional investors. This leads to amplified price movements in both directions as fear and greed drive irrational behavior. News cycles also heavily impact sentiment. Positive news about adoption, partnerships, or regulatory clarity can spark rallies, while negative headlines about hacks, bans, or technical issues trigger sell-offs. The speed at which information spreads in the digital age means sentiment can shift rapidly, causing equally rapid price movements that traditional markets rarely experience. Regulatory developments and government actions. Regulatory news plays a powerful and often immediate role in shaping the cryptocurrency markets. Among all external influences, government policies and legal announcements consistently rank as some of the most impactful forces that can trigger sharp market movements, both upward and downward. Cryptocurrency, by nature, operates in a space that has historically lacked clear rules. Unlike traditional financial markets that are heavily regulated, the crypto world has grown rapidly in a kind of legal gray area. As a result, any official announcement from a government, central bank, or regulatory agency can create a wave of uncertainty or confidence, depending on its nature. For example, when a country introduces strict regulations or outright bans, it can cause widespread panic among investors. A clear illustration of this is China's repeated crackdowns on cryptocurrency trading and mining. Each time Chinese authorities impose restrictions, whether banning exchanges, shutting down mining operations, or restricting financial institutions from dealing with crypto, the market reacted sharply, often with steep sell-offs and rapid price declines. These events highlight how dependent the crypto ecosystem can be on government attitudes. On the flip side, positive regulatory news tends to boost investor confidence and drive prices higher. When a country unveils a clear legal framework that supports crypto innovation, or when regulatory agencies provide guidelines that legitimize the use of digital assets, the market often responds with enthusiasm. Similarly, when major financial institutions, like banks or asset managers, receive legal approval to offer cryptocurrency services, it opens the door to institutional capital, which increases demand and, in turn, drives up prices. A key example of this effect is the approval of Bitcoin ETFs, exchange-traded funds, in several countries. These financial products allow investors to gain exposure to Bitcoin through traditional stock markets without having to directly own or manage digital wallets. Every time a new Bitcoin ETF is approved, such as in the US, Canada, or parts of Europe, it is seen as a major step toward mainstream acceptance. This often leads to a surge in market activity and notable price increases. Institutional adoption and corporate investment. Institutional adoption has become increasingly important as traditional finance entities enter the crypto space. When major corporations like Tesla, MicroStrategy, or Square announce Bitcoin purchases for their treasury reserves, it validates cryptocurrency as a legitimate store of value and drives significant price appreciation. Financial institutions offering crypto services create new demand sources and add credibility to the market. When banks like JP Morgan or Goldman Sachs launch crypto trading desks or investment products, it signals shifting attitudes toward digital assets within traditional finance. This institutional involvement typically reduces volatility over time as professional investors bring more sophisticated trading strategies and risk management. Exchange-traded funds, ETFs, and other investment products make cryptocurrency accessible to traditional investors who might not want to deal with digital wallets and exchanges. The launch of new crypto investment products often coincides with price increases as it creates new buying pressure from previously inaccessible investor segments. Technology updates and network developments. Technical developments within blockchain networks significantly impact their associated cryptocurrency prices. Major protocol upgrades, like Ethereum's transition to proof-of-stake or Bitcoin's Lightning Network development, can drive substantial price movements as they address scalability, security, or functionality issues. Smart contract platforms are particularly sensitive to technological progress. When platforms like Ethereum, Solana, or Cardano announce major upgrades or achieve significant milestones, their tokens often experience price appreciation. Conversely, technical problems, network congestion, or failed upgrades can cause immediate selling pressure. Developer activity serves as a leading indicator of a project's health and future potential. Cryptocurrencies with active development communities and regular code commits typically maintain stronger price performance over time. GitHub activity, developer conferences, and technical partnerships all influence investor perception and trading behavior. Market liquidity and trading volume. Liquidity plays a crucial role in crypto price movements, particularly for smaller altcoins. Low liquidity means that relatively small trades can cause large price movements, creating the extreme volatility crypto markets are known for. During periods of high selling pressure, illiquid markets can experience flash crashes as sellers overwhelm available buyers. Exchange listings significantly impact liquidity and price. When major exchanges like Binance, Coinbase, or Kraken list new cryptocurrencies, it typically causes immediate price increases due to increased accessibility and trading volume. The Coinbase effect refers to the common price surge that occurs when Coinbase announces new asset listings. Market makers and algorithmic trading firms provide liquidity but can also amplify volatility during extreme market conditions. When these systems pull liquidity during periods of high volatility, it can exacerbate price movements in both directions. Understanding how market structure affects price discovery helps explain why crypto markets can move so dramatically compared to traditional assets. And that's a wrap on what really moves the crypto market. Now you've got a clearer picture to help you stay calm and smart during market swings. If you found this helpful, give it a thumbs up and share your questions or thoughts in the comments. And don't forget to subscribe and hit the bell for more simple crypto tips. Catch you in the next video.